There we go. Now we've just been listening to Zahir, who is a longer term trader. And of course, VectorVest is a program which can assist in that, highlighting trends as well. But not only does it use technicals, but it uses fundamentals, which I think is one of the titles of your presentation today is to explain how all that works together to produce the high trending shares.
That's correct, yes.
Fantastic. So I'll hand over to you as we do, and we'll go straight into the presentation. We'll take some questions towards the end, if that's okay.
Okay, that's great. Good morning, everyone. It's great to be here, Simon. Thanks for having me. I've done quite a few of these in the past, but Simon tells me there's new people in the room, so I'll give you a little bit of my background. I've been trading in markets. I put on my first trade in October 1982, and I was working for the Diamond people, De Beers at the time, and I worked while I traded from 82 to April 1988. And in April 1988, I sort of cut the corporate umbilical cord for good, and I've been trading on my own ever since. I suppose along the way, I was talked into doing some seminars in the stock market once upon a time, largely by accident. I went to an investment meeting one night, and the speaker got laryngitis, and they coaxed me into taking the meeting. It went well, and in the audience there was several stockbrokers, and those guys asked me to come into their office and to coach their juniors in stock trading, and that's how this all started. I did a seminar at London-listed Old Mutual some years back, and one of the attendees was a London trader called Tom Hogarth, and Tom and I put together, based on friendship, a little company called Which Way Today, which give real-time signals in the Forex and the indices market, which we ran together for some years. We sold it. Neither of us have any involvement with it anymore. And while I was in London working with Tom, I went along to a VectorVest presentation. I was so impressed with VectorVest that I managed to get the agency for South Africa, and my son runs VectorVest in South Africa these days. Simon, our host, was running VectorVest in the UK, and Simon wanted to move on and focus on this media business that we're listening to today, and VectorVest asked me would I like to in fact be run VectorVest in the UK, and that's what I've been doing for the last 3 or so years now. So I think that VectorVest is pretty much the only company that's here today, and certainly I think the only company in the United Kingdom that provides investment education and investment software that's fully in fact authorized by the FCA. And to that end, I have to put up this disclaimer that although I'm allowed to give, qualified to give financial advice, I actually can't give any financial advice in the absence of doing a very long and detailed fact find. So, and that's something your financial advisor will have probably have done with you over the years. So we haven't got time to do that this morning. I'm allowed to talk about what I do myself, but I'm not allowed to give one-on-one financial advice. So that said, we can move on. And what I'm going to try and talk about this morning is, first of all, very quickly, the VectorVest system itself. I want to try and talk about how we actually quantify when it's a really good time to be in the stock market and when it's not a good time to be in the stock market. And one of the key exercises, folks, is to work out when the market is rising, when the market is falling. Everything follows from that. So we need some form of objective methodology to work out whether the London market is rising in the time frame that you're trading in. Before we can define the trend, we have to define the time frame. Those of you that are short-term traders will know very well that the hourly trend might be up, but the daily trend could be down, etc. And getting your mind around that is quite something. And then what we're going to try and do later on in the presentation, we're going to try and put together trading price action and earnings momentum together. And this weaves its way throughout the whole of VectorVest. Our edge in the markets is based on combining fundamental analysis and technical analysis. And I do some interviews now, and TV station called Tip TV with my dear friend Zach Meir. And Zach says that VectorVest is the best of both worlds. We want to try and put the best of fundamental analysis together with the best of technical analysis. And for the first, well, I started in 1982. I tried to keep the fundamentals up to date in the early days, but I didn't have the tools, ladies and gentlemen. I'm a mechanical engineer. I can still see the annual reports and the interim reports piling up in the corner of the office. I just didn't have the tools or the time, and quite honestly, the interest to keep them up to date. So for the first 25 years of my trading career, I traded just technically, just with trends. My definition of technical analysis is the study of trends and turning points. And I made myself an expert in trend analysis. I made myself an expert in price analysis. I know as much about Elliott wave analysis and Gann analysis as anybody in the world. And I spent a lot of time coming to grips with indicators and momentum divergences, which I still use. But when I combine that with fundamental analysis within VectorVest over the last 5 or 6 years, my hit rate has gone up enormously by putting both together. So for those of you that haven't been able to get the hit rate out of trading that is emotionally satisfying, then by putting both aspects of market analysis together, I believe that you can get your hit rate up to 7 or 8 out of 10, which is quite unusual in this line of work. Okay, that's what we're going to talk about. So the VectorVest Edge itself, we combine the fundamental position of a share with the technical position of a share with the technical position of the overall market. When all three are saying yes, the future can be determined with the certainty that's unusual for this line of work. Now, ladies and gentlemen, I'm very much a tick-the-boxes type trader. I firmly believe that all the decisions that you make in your trading plan should be binary. In other words, yes or no. So if you've got a trading plan which asks, if you want to ask a question of yourself within that trading plan, don't open it up too wide. Make it a yes. Make it a binary yes or no. Okay, so the fundamental position of a share, the technical position of a share, and the technical position of the overall market. And at VectorVest, we've done our best to try and put numbers to all of those so that we can actually answer them objectively without any form of back scratching or whatever part of your anatomy you have to scratch to make a decision. I'm more than happy to allow everybody to try VectorVest for 5 weeks for a $5. If you don't think it's the best $5 you've ever spent, you can have your £5.95 back with the greatest of pleasure. After that, VectorVest is invoiced for both the UK and the US at £44 a month. It's on a month-by-month basis. Here's my promise to you. If I cannot make you money, you stop it at any time. Simple as that. So there's no £2,000 weekend seminars or anything like that. It's £5.95 to test it. If it's for you, great. It's £44 a month. If it's not for you, we shall remain friends. If you go to vectorvest.co.uk /RTC, which I'm sure Simon will post, that will in fact get you that little offer today. This includes full access to the VectorVest University and my little VectorVest Quick Start course that I'm very proud of. So let's get into the meat. The 3 things that we want to try and answer. What's the share really worth? How safe is the earning stream? Those are both fundamental measures of the company. And then a technical measure, when to buy, when to get out, and when to sit. Okay? And I really like what the previous speaker said about adding to positions. And I've been at this for a very, very long time now. And all I know is that you get paid for doing the difficult things. The crowd out there, in fact, will buy a share at £10. When it gets to £10.50, they'll take the 50p profit. But if you really want to make money, when the share goes up and it goes from £10 to £11, you buy some more. And when it goes to £12, you buy some more so that you leverage yourself in. When you're right, you want to be right with a big position. And when you're wrong, you want to be wrong with a tiddler. Now, the crowd will do this completely arse about face with the greatest respect and deference, Simon. When they buy a share at £10, when the damn thing goes to 9, they should run for cover, and they should be running for cover with a tiny position, but that's rarely the case. They normally buy some more at 9. So unfortunately, along the way, I've done the same thing myself in the very early years. It cost me a lot of money, about 1984. In fact, cost me a lot of money in 1984, and I resolved that that would never happen to me again. So when you stick your little toe into the market with a position, as it goes your way and the market proves you right, you buy some more. This can lead to problems in position sizing and money management. Now, over the last couple of years, I bought into a company that we all know on the high street called JD Sports. I bought into it at £4. Now, it's had a 5-for-1 split since. It went, I think, till £16 before the split. And I added to it quite a few times along the way, which means that at the moment, a disproportionate part of my wealth is in fact in JD Sports, and it's something that I meant at the start of the year to rebalance. In other words, to sell out of that share because I was too big a percentage of my portfolio was there. I still haven't got around to doing it yet because the share is still rising, which I suppose is weakness, but it's a grand little problem to have, okay, when you build a position. So just think about that. Learning how to build a position is absolutely fundamental to your ability to make lots and lots and lots of money. And I would hazard a guess, ladies and gentlemen, that if you are trading and you're not really losing money and you're not really making a lot of money, is there anybody out there that would like to put their hand up in the Simon's chat room and say that that's the cap that they're wearing? I can pretty much guarantee that if you start adding to winners, that you will in fact come out of that. Okay, so maybe Simon will be able to tell me if anybody said that that is the cap they're wearing. So let's look at the fundamentals. VectorVest was put together by a very capable chemical engineer called Bart DeLido, and he put the program together 28 years ago. He was a fundamental analyst to start with, which I was a technical analyst, as I've just said, so we make a good match. So Bart is his core is a fundamental analyst, and he put together over the last 28 years an algorithm which in fact calculates the value of every share in the London stock market every evening. So you can see at a glance whether your share is overvalued or undervalued, and we wish you to actually get involved with undervalued shares. Okay, and I like myself to be getting involved in shares that are trading at least 20% below the VectorVest valuation. That's a massive edge on its own. Now, another very important number is relative value. And relative value is, as the slide says, is an indicator of the long-term price appreciation potential in relation to a AAA rated corporate bond. So here's what we do. We project the earnings of a company for the next 3 years. We assume that those earnings will be fully discounted into the price at some time over the next 3 years, and we work out what the price will be. We take the projected price, subtract the price today to work out the upside, and we divide that upside by what a AAA rated corporate bond will pay over the next 3 years. And the difference is relative value. If your share has a relative value of 1.3, that means that your share should outperform a AAA rated corporate bond, which is our measure of the risk-free rate, by 30%. Anything above 1.3, VectorVest reckon, is excellent. Now, in my humble opinion, this is the most important number on VectorVest. It drives the share price. And we'll see a little bit later in one of my searches, my favorite search, is that I actually sort the search by relative value, and that brings the shares with the highest relative value to the top of the pile. So by looking at shares that are undervalued and shares with a high relative value, we've already added a tremendous edge. The next number is relative safety, which is an indicator of risk. The computer looks at the financial statements, balance sheet, the income statement, the cash flow statement, which we buy from Thomson Reuters, for every company in the London stock market and a name, and we make a judgment on the consistency and the predictability of the financial performance. Mathematically massaged, like everything else on VectorVest, between 0 and 2, and above 1 is good, above 1.3 is excellent. Above 1.3, this is a company that's making heaps of money, and all those ghastly financial ratios that I struggle with still are getting better. Okay, I'm still an engineer. The third number, relative timing, which measures the trend. It measures a short-term price trend, I think, in its calculation. I know the room is sort of populated by technical analysts. It's probably closest to Jerry Appel's MACD in its derivation, and it measures both the direction and the strength of the trend. Again, mathematically massaged between 0 and 2. Above 1, the share's rising. The further above 1, the faster it's rising. And then what Bartolito did was he put all three things together. And when I first saw this, in fact, in one of Simon's presentations down Gloucester Roadway in London, he put together relative value and relative safety with relative timing into the one single number. And I just didn't believe that afternoon I saw it first, because this was somebody who'd put together the fundamental position as measured by relative value and relative safety, and the technical position as measured by relative timing, and put those into the one number. And as a default, ladies and gentlemen, all of the shares on the London market, on whatever market VectorVest follows, we follow most of the main markets around the world, then they are rated by the master indicator VST. That brings the shares with the highest combination of value, safety, and trend to the top of the pile. We put a stop loss to every share in the market every single day. The stop loss is based around a 13-week, 65-day moving average, but it's adjusted. It's adjusted for the fundamentals. If the fundamentals are good, we widen the stop loss, we give the share more wiggle move. If the share has got a high average true range, we also adjust the stop loss to try and keep the stop loss out of the traffic. Now, your rules on profit taking are your rules. Ladies and gentlemen, we don't know what the market is going to do next, but we should know what we are going to do if the market does something. So you could be selling out at when you made 3 times as much as you've risked. You could be selling out at an old high. That could be your rules. You could be selling out at the Fibonacci level, if you understand Fibonacci targets. Or you could be letting the position run and pulling a stop loss up behind you. Now, if I'm trading with leverage, ladies and gentlemen, on a short-term position, okay, and I do a lot of that over a few days to a few months, sorry, hardly a few months, a few days to a few weeks, then I invariably, in my trading rules, have a target. And that target for me will be based on a Fibonacci extension level, which I don't think I'll have time to cover today. But in my unleveraged portfolio, where I'm buying into shares that are undervalued, that are growing their earnings aggressively and safely, I invariably let them run up the page and trail the stop loss up behind them. In a leveraged position, I find that the pullback to the stop loss, in fact, causes emotional problems for me. So I like to sell into a target. I like to sell into strength in a leveraged position. Your rules are your rules. There's nothing cut and fast. But the only thing that you need to know, ladies and gentlemen, when you go into a trade, as you hit the little button, you need to know where you're going to get out if you're wrong and where you're going to get out if you're right. And you need to have pre-visualized how you're going to add to that position as it goes up the page. We do not know what's going to happen next, but we should have mentally prepared ourselves for what we're going to do under any market scenario, and I do still some training at the institutional level. In fact, the only training I do these days out of VectorVest is at the institutional level, and we spend days upon days working out and planning to the last detail what we will do under a dozen different market scenarios so that there's no ambiguity. So you need to plan for that. You need to think about what you're going to do should the market do something, so that when it does happen, when something does happen, you're not sitting there panicking. Okay. Simon, can you hear me okay out there?
Yes, David, we can hear you fine. Thank you.
I haven't had a comment in a while.
Ian and John both agreed, threw their caps up when you asked if anybody was making money in the markets.
I think that the most common thing that I hear from every institutional traders, from retail traders, they've been at the game for a little while, and they're not losing money, they're not making money, and they're getting frustrated. And the answer to that always is adding to positions, always. Okay. And that old 80-20 thing is true in trading, I assure you. You make 80% of your loot from 20% of your trades, and getting your mind around that is quite something. But it is true. VectorVest, I put a buy, sell, or hold recommendation to every share in the market every single day. Now, ladies and gentlemen, these are largely trend-following signals. The only fundamental input into the buy is that the VST is greater than 1. So largely, these are measuring whether the share is rising or falling. And there are some very simple rules here. Now, the most important part of the buy and the sell is to measure the breadth of the market. And we measure breadth by calculating on a daily basis the buy-sell ratio. And when I get into market timing in a second, you'll see how important these are, because they give some magnificent, in fact, leading indicators of price change. For example, when the buy-sell ratio gets on its knees, invariably the market's oversold. And when the buy-sell ratio gets too strong, invariably the market is overbought, and it's saying, be careful here. And we'll talk about that momentarily. So some wonderful leading signals from the buy and sell. So our objective of working out buy and sell is not really to time the market, but to work out market breadth. And if you're a technician, as I was for 25 years solely, you cannot do too much on market breadth. Really, really, really important. And the Americans, for example, do an awful lot of work on the advanced decline line, which is absolutely vital if you understand that American market. But our buy-sell ratio is a much strong, it looks at the whole market as opposed to the advanced decline line, which is just based on the Dow stocks. So let's look at the program itself a little bit now. And now I want to go into the VectorVest program. That's the front page. Now, don't concern yourself. The front page has got an awful lot of information on there. And when you see it for the first time, you take a big deep breath and you say, I'll never get my mind around that. It's done like that so that when you get out of bed in the morning and you look at your smartphone, in fact, invariably before I do get out of bed, then I have a quick look, and I can tell from the one page exactly what's happening. But I'm more than happy to admit that you might find it just too much information in the first go. I want now to look at some shares, and the shares are under viewers. And when you go into the spreadsheet, for the very first time you go in there, there's going to be nothing in here. And you've got to sort of click on stock viewer or industry viewer or sector viewer or dividend viewer if you wish, and that will populate that. I've just populated it with the top 50 as defined by VST, our master indicator, out of the 2,162 shares that we follow on the London market and AIM, because although my technician here at our office at St. Paul's tells me that our internet is as good as money can buy, I'm always nervous because last week it let me down. So not in one of yours, Simon, but in another presentation I did, it let me down. At the top, we've got the Coates Group. I put a trading call out on this yesterday, and I do my best to walk the talk, ladies and gentlemen, at vectorvest.co.uk/blog. If you go to the website, you'll see my efforts. Simon also sends out some of my efforts. Simon's much appreciated. So the Coates Group, there's the symbol. It's listed in the London stock market. It's trading at 59. Now, you can get that out of the Evening Standard for free. Now, the first proprietary number is our valuation, and we believe it's worth 78. So, eyeball, we can tell that that's good. Okay, it's trading below the VectorVest valuation. That's our first tick, and it's actually trading 20% below it plus. It was up 1.5 pence yesterday, which was 2.61%. The second proprietary number is relative value. So remember, value is the value we believe it's worth today. And relative value is our best shot at the future. Now, Mark Twain said that the future is a very slippery commodity, and he's in fact correct there. But that's our best shot at the upside over the next 3 years in relation to a AAA rated corporate bond. And that's 1.53. On the scale between 0 and 3, 1.3 is excellent, and I have my own rating above 1.5, which is just called bloody marvelous. And the higher the better. It drives the share price. So there's 2 ticks. Relative safety on a scale between 0 and 2 is 1.25, and that's good. Not quite excellent, but it's good. Anything above 1.0 is good. And that is fairly stable. It's a company making money, and all those ghastly financial ratios are getting better. RT is 1.63, and when we combine all of those, the VST is 1.48, which is the highest in the pack. It's on a buy recommendation, and our stop loss is at 47.97. We believe it's going to grow earnings next year at 28%. This is a very interesting number. This is our best shot at earnings yield. PE doesn't pay a dividend. Growth to PE is a really cool number, and this is some of you that are maybe longer in the tooth like myself will have read Jim Slater's book of 20 years ago, the Zulu, maybe 25 years ago, the Zulu Principle, where he talked about the peg rate. VectorVest look one over the peg rate, which is growth to PE. And here we're saying that the growth of the share, 28, divided by the PE is 1.63. That's a measure of value. That's good. In other words, it's growing much higher than its price to earnings ratio. That's a good number. There's some really good ones around. For example, 3i's got a growth to PE of 4.59, which looks quite impressive, and I'm a shareholder there. That's one of the reasons. Go to the right-hand side. We can see lots and lots of other stuff, volumes, average volumes, market cap, etc. Okay, on Coates, and a reasonable size of a company at 830 million market cap. All right, and of course, I've got the chart of the share, but we can bring up a chart. I hope this is not going to affect the sound quality, and if I can pull up a chart. And there's the chart in my normal format, folks. Put up a 6-month chart. There's the price in a candlestick format. There's earnings per share. Now, Benjamin Graham, Warren Buffett's mentor, and for that needs to be taken pretty seriously. He says that earnings per share is the engine that drives the share price. This is our valuation, so it's undervalued. Earnings per share is rising, and the share price is rising. And don't make it too complicated, because it doesn't have to be too complicated. Just keep buying them as they break out, and you do make good money. So with VectorVest, by putting together a trend and putting together earnings momentum, you'll find that most of the darn breakouts work. I really liked Coates when I saw it yesterday, because the father of technical analysis is a guy called Charles Dow. And Charles Dow stood in the corner of Wall Street and Main Street selling his newsletter 130 years ago. The newsletter these days is called the Wall Street Journal. He was selling it for 1 cent in those days. he said there was 3 types of trends, and this was his own way of working out momentum. So he looked at a strong trend, a normal trend, and we call it a creeping trend. So I'll do my best to try and draw this. If I'm not in the VectorVest, I'm not in PowerPoint now. But if a market pulls back and that low is higher than the previous high, and there's what Dow called a positive gap in there, he defined that as a strong trend. A normal trend, this reaction low will come back and kiss that high. And in a creeping trend, this reaction low will come back and impinge on this high. So this is what Charles Dow would have called a strong trend, and he felt that this trend is going to keep going, and that was one of the reasons yesterday that I, in fact, called the share in my blog. It's undervalued, it's growing earnings strongly, it's got really good earnings safety, and I think it's moving up from here till about 70. Relatively easily and without a great deal of effort. That's assuming the general market can move up with it. So that's the concept of a strong trend. Let me just see if I could draw that for you. Strong trend, market moves up, comes down, goes up, comes back, and there is a gap between here and here. That's a strong trend. Normal trend, well, that's the same. And that happens most of the time, a pull back to that old high. And a creeping trend, where this impinges, and what Dow said, that was a negative gap from there to there. Okay, and that's what's called a creeping trend, and Dow felt that either when you saw one of these, either the market's going to consolidate for a while, or in fact the trend was kaput. And those were Charles Dow, the father of technical analysis, his own method of in fact assessing momentum. These days we've got all sorts of oscillators and things, but you'll find that if you see a market in fact making a positive gap here, that's when you should be adding to positions big time. Okay, and then this is still good to add, and when you see the market starting to creep, then you want to pull back a little bit. You might want to start to take some profits there, depending on your trading rules. But as soon as I see a market starting to creep, then I don't add anymore. That's a part of my rules. I may hold the position, but I don't add anymore. So I hope that helped. That's a very simple and 130-year way of looking at market momentum. Keep discard. That always gives me a heart attack when that comes up. So if I go back to the program again, I can look at another share. Now I hope Stuart, our user, ladies and gentlemen, we have user groups. I'm building user groups up over the around the country. We've got a great one in London, run by a great lady called Susan Thornborough. I'm off after this meeting. I'm off to Paddington to catch the train to Oxford, where we have a wonderful user group, incredibly experienced users out in Oxford this afternoon. In fact, we have it on a rugby club, Simon, and I just love the user group because I relive my best years chasing that ball around a rugby club. And the social, we have it in the bar of the rugby club, which brings back very fond memories of post-game events. Stuart up in Manchester is the proud shareholder of Enterprise Ends, and Enterprise Ends, he's been in it for quite a while now. At 133, 164, I'm not in Enterprise Ends, not because I didn't want to be, but because I didn't have any money left. Does that ever happen to anybody else out there where you want to buy something but you've got no loot left? You've fully invested in everything else. So it's trading at 164. We believe it's worth 133. It's up 1.5 pence yesterday. Our relative value is 1.33. Our relative safety is 1.03. Now, this is not as good as the case on Coates. So what's happened here is that over the last few years, there has been ups and downs. There have been targets that have missed. There have been sales projections that have missed. It's still above average in the data stream, but there's a little bit more risk here, which is saying that you need to watch yourself, you need to be more careful here. RT is 1.71, which is saying it's going up strongly. And when you put those three things together, it's got the fourth highest VST in the pack. There's the stop loss. We believe it's going to grow earnings at 21% next year. And the growth to PE is really good. It's growing its profits well ahead of its PE, folks. Now, you make money in markets by capital gain. You make money by dividends. And the third thing, how you make lots of money, is a re-rating, where a company starts to come right and it's actually re-rated with the sector. And the PE of this at 7 has got a lot of ability to be re-rated to double. Okay, so that growth to PE is incredibly important. So let's just chart this little fella. Now you don't have to stress to do this. It's relatively easy, and there we have. There was the earnings per share is growing, and since March last year, earnings per share has gone from 5p to damn near 20p. Okay, that's one hell of a rise. As you can see, during the course of the year, VectorVest revalued the share. Now, if you get a ramp up like this, that means that the numbers have come out from the annuals or the interims, and the numbers were considerably better than we forecast. So if you see a ramp up like this, it means the numbers were much, much better than we forecast. If you see a ramp down, then the numbers were awful. Okay, I would have thought that Pearson would be a bit like that after yesterday's revelation. So all of a sudden, this market started to move up, and it broke through, and it made a rising bottom here. And yours truly, being the technician, drew my little trend line in like so, and I said, hey, I've got a wee triangle here. I love my triangles and patterns. And not everybody likes patterns. I did a seminar in London the other night, and there was a fundamental analyst in the room, and he said that I was reading the tea leaves, and maybe he's correct. But the gist of VectorVest is putting together fairly simple trend following analysis with good, solid fundamentals as defined by the program, and there's no heavy lifting in the fundamentals. And when this started to break up through here, it broke that triangle. The VectorVest buy signal is saying buy, and we've been in it. I've been talking about it, and I think Stuart in Manchester's in it from about 110, 105, 110. It's now going great guns up the pitch, and he's up 30% in the share. So folks, you don't have to do a great deal of work. I'm going to show you in a second how to actually scan and find these shares automatically without any effort whatsoever. I personally don't do a great deal of scan. I don't do as much scanning as maybe I should, and that's because I like going into the charts, and that's because of my background, all right, that I just like getting into charts, and I spend my weekend looking at charts, and I keep it very, very, very simple indeed. So that's a couple of shares. I'll put up Premier Oil in a moment when we get there. But nevertheless, that's a really good example of a very simple setup. The earnings per share is rising, the share is undervalued, and it just breaks out of one of these highs. Dr. Toledo himself looks at a 52-week high, so he would have been buying into the share at here. I would have thought here. He looks at a 52-week high, so he would have been buying in just there. Okay, at slightly over 100. If by using my triangle I could have gotten in below 100, but if you had got in about 100, 105 at the 52-week high, and you're sitting now at 133, well, if you told that to the people in the city, they wouldn't believe you. Okay, simple as that. So you don't have to stress to make good money with VectorVest if you tick the boxes, finding shares that are undervalued, growing their earnings aggressively, reasonably safely, that are rising. And very important, ladies and gentlemen, we want to be able to ascertain when the general market is rising. And that's what I'm going to come on to now before I run out of time. I invariably run out of time on these things. That's why I put the offer for VectorVest at the start, because I normally run out of time. So VectorVest has been timing the market for a very long time. And we have perfected several systems that identify market trends with accuracy and precision. Now, what I mean by that is that they're totally and utterly objective. Now, before you can define the trend, you have to define the time frame. So we have got long-term systems for investors, and we've got short-term systems for traders. and I myself have different portfolios, and I keep those portfolios at different brokers. I have in my short-term trading, I have two portfolios, one for leverage trading, which is a spread betting company. I won't tell you which one, but they paint their walls red. And I have another account for short-term trading of shares, which tend to last 2 to 3 weeks. And then I have an account for my longer-term unleveraged positions. Okay, so 3 of them. And then I have another account that I don't touch much, which is in fact for pension shares focused on yield. Okay, and I keep them in 4 completely different places. So to time the market, we look at the VectorVest composite. Now, what is the VectorVest composite? It's a composite indicator of all of the shares that we follow on the London market, equally weighted. So, and please correct me if I'm wrong, but it is the broadest measure of the UK market that I know of. Certainly much broader than the FTSE 100, which is market cap weighted, much broader than the FTSE 350. It's all of the shares that we follow on the LSE and on AIM, all 2,200 odd shares. We look at the price of it, we look at the breadth of it as measured by the buy-sell ratio, and we look at the momentum of it, or the RT of the VectorVest composite. And we put all 3 things together. Now, we have short-term systems, and if you're technically based, we call the short-term trend the primary wave, and that's based around a 5-day rate of change of price, momentum, and breadth. And we have longer-term systems which are loosely based around a 21-day rate of change of price, momentum, and breadth. And ladies and gentlemen, we actually have 5 systems that run from those traders that want to be in the market for 2 to 3 days, right through to those guys that want to have a methodology to work out whether the general market is rising or falling for long-term trades. Okay, and to minimize chart watching, now those of you listening that are primarily technicians may find this strange, but there are lots and lots of people around that just don't understand charts. I mean, really, really bright people out that don't understand charts. It just make no sense to them whatsoever. So we've coded this in 2 words, up and up, and I in fact haven't updated this because this should be down and up. That's very remiss of me. I did this the other day. The trend changed. As I write, the trend is down and up. That means that the short-term trend is down and the longer-term trend is up. And we record that on the front page of VectorVest every day for those people that don't want to look at charts. So this morning, in fact yesterday as well, when I actually looked at VectorVest on my smartphone in the morning, the trends are down and up. The short-term trend is down, the long-term trend is up. And that's reported on the front page every single day. So the short-term trend would in fact be used by short-term traders, swing traders, spread bettors. Longer-term trend would be used by investors to work out, is this a safe time to be in the market? Is this not a safe time to be in the market? So before you can define the trend, you need to define the time frame. And between those 2 measures, ladies and gentlemen, we have another 3 measures of the market that I definitely haven't got time to go into today, but they're all in my little quick start course. So the short-term trend is diagrammatically shown on this thing called the color guard. And at the moment today, the color guard is neutral, and VectorVest doesn't advocate buying stocks at this time. Short-term trend is down. Maybe you can see it. Down, up situation. All right. So in your face, that tells you that there's nothing to do today, and we would be waiting for the little pointer to go into the green. When it does get into the green, it will say VectorVest recommends buying safe, undervalued shares that are rising in price at this time. You get very lucky when you follow what the damn thing tells you. Now, the longer-term trend, as I say, is a 21-day rate of change. Now, the candle plot is in fact the VectorVest composite over the last year. Down below, we have a very special oscillator called the MTI, the Market Timing Indicator. The Market Timing Indicator is a 21-day rate of change of the price of the composite and the buy-sell ratio all rolled into one and then mathematically massaged between 0 and 2. Now, when the MTI comes up through 1 and the market has traded up for 2 weeks in a row, we put a green triangle on the chart. When the MTI comes down through 1 and the market has traded down for 2 weeks in a row, we put a red triangle on the chart. Now, these are the longest term measures of the trend on VectorVest for long-term buy and hold traders, and they're absolute magic. They're called confirmed calls. At the start of last year, the first trading day of last year, we got a sell signal from a confirmed call. And that market fell into the middle of February. If you remember, that was quite a violent sell down the page. We then got a buy signal on the 22nd, I think, of February from memory, and it was long the whole way up the page. Even Brexit didn't shake it out. We had the sell-off, which came right down into Trump's victory down here, and all of a sudden, we're now moving up the page, and that's still current at the moment. The short-term trend is down, as you can see by that red, big red candle, and the longer-term trend is still up. Now, I spoke to you a moment ago about divergences, and in my blog, I talk about this every single weekend because the divergences give you a really good leading indication of change. And I'll put them up here. For example, in this period, the price was rising, but the MTI was falling. And that is what's called bearish normal divergence. And when we got the signal, I wasn't at all surprised that this was going to come back. And I wrote about that in all of that period. So if you do read my blog, you'll be well, in fact, you'll get some advanced signals here. Now, this signal was, in fact, forecast by 2 divergences. We had a reverse divergence, for those of you that know what that is. Price is rising, indicator is falling. And that's what some people call a slingshot. But also we have a little bit of bullish divergence where the price fell and the indicator rose. You see that? And we had the same thing here. Price fell and indicator rose. So divergence, really, really useful. But if you don't understand divergences, and some people struggle with charts, as I say, then just follow the signals. The signals are robust. Ladies and gentlemen, you need to know when the general market is generally rising in your time frame and generally falling. When the market is rising, you want to be a lion in the market. And when the market is falling, you want to be like a lamb, watching your stop losses carefully. Certainly not buying any more. Getting rid of shares. Let's say that you've got a share in this up move here that's done nothing for you. Okay, that's just hanging in there. Maybe it's made you a couple of percent, maybe you're down a couple of percent. When you get a sell signal like this, get rid of the darn thing, raise some cash, so you get some money to get involved when the market does turn up again. That was last year, and that was a really, really good year. Some interesting times here, I know, that one had to be strong, but a good year. Now, the buy-sell ratio and the MTI have got some leading characteristics. And folks, when the MTI gets down to about 0.5, 0.6, that's a great time to be buying shares. And when it gets up to about 1.5 to 1.6 is where we're at the minute, that's a very good time to be careful. Similarly, when the buy-sell ratio gets down to about 0.2, that's always a good time to be buying shares. So these tools have got some leading characteristics that will give you a heads up, if you understand them, well before the signal. And that's important because it allows you to mentally prepare for the signal. Like signals that appear out of the blue are difficult to take. I know everybody says they're John Wayne out there, but markets are always easy and simple in hindsight. When you're actually trading them, they're far from that. So everybody thinks their Joan Wayne. If you're prepared for this signal, as I was, and I wrote about it for a couple of weeks, based on the reverse divergence on the between the composite and the MTI, and the buy-sell ratio down here in less than 1, much less than 1, then I was really, really prepared for that signal, and I was pretty sure that the probabilities favored a nice big move up the page. Bart DeLito, who writes a weekly essay on markets, in fact, said that when the turn comes, it's going to be hard and fast, based on the buy-sell ratio being right down on its knees. At the moment, it's a time to be careful. It's a time to be careful. Okay, and that's just really what I've talked about. If the buy-sell ratio gets up above 4, market very overbought. The buy-sell ratio gets down below 0.3. And ladies and gentlemen, I've found that if the buy-sell ratio goes down below about 0.3 and the MTI gets down to about 0.6, that you have a major buying opportunity. I call it an investor cycle low. 2 of them happened last year, in the middle of February, in the middle of November. 2 of them. And if you want to get rich in this business without sweating, in other words, sitting in positions that go nowhere for weeks and months on end, you've got to be a little bit brave and stick your toe into the market at these oversold situations. If you're right, add to the darn position. If you're wrong, you've taken a small loss. But as I say, if you want to get in without sweating for weeks and months in positions, you've got to be brave. Okay. So now I've done a little bit of this already, but now I'm going to try on this coats, and that's what I've talked about. I wrote about it yesterday, and it's moved up since I called it yesterday as it broke out through that top. Premier Oil I called in exactly the same way. Again, it's this fusion of technicals and fundamentals. I had this inverted head and shoulders reversal. It's on a buy signal. It was undervalued. Earnings per share rising. And I said to everybody, it just needs a close above the neckline of the head and shoulders reversal. That's the target, and still heading towards that target as I speak. Up around 100, and again, for me, this is a leverage trade. I've done it on a spread bet, and I have a target, and a little bugger just missed my target by a tick or two, and I wasn't watching it. Okay, so what can you do? I'm still hanging in there. I'm looking for a run to 100. As I say, if I have a leverage position, then I will always put a target in the market. If this is a longer-term position for me, on a non-leveraged position, then I will just edge the stop loss and take the run up the page. Those are my rules, and there is nothing else apart from your rules. There's nobody out there with a divine prescription, I assure you. You need to know, ladies and gentlemen, what you're going to do under a myriad of market circumstances, and your success will be directly proportional to the planning and the visualization and the journaling that you do around that. And as I say, in my 3-day trading psychology course that I do, I'm doing one for Barclays in the next month or 2. That's primarily what we do, okay? That I mentally prepare them for pretty much every situation. And at the institutional level, you can work wonders with options as well, okay? Which is difficult at the retail level, okay? More difficult at the retail level. 3i. This is 3i. I call it 3i, but a lovely little entry down here at that double bottom. Earnings per share rising beautifully, significantly undervalued, and the growth to PE is 4. Okay, so I'm expecting a significant re-rating here. It's sitting, it's doing nothing at the moment as the market goes sideways, and if the market should turn up and we move into an up situation again, and you see that moving up the page, then I think that's a definite candidate. I'm currently holding the share, but the FCA requires me to say that although I may be holding the share, it may not be suitable for you. Okay, so just do your own numbers. You are your own captain in this world. CAS. I've added to CAS. I bought CAS there. Now, those of you that are technicians will see this textbook cup and handle. You see it? Made famous by a mentor of mine, William James O'Neill. The share is undervalued. Its earnings per share is rising beautifully, and it charts this textbook cup and handle. I bought it there. I added to it there, and we've now got another one of these little fellas in the making. See it? Round, and a wee handle. If that goes again, I'm going to add to it again. Just there. Okay, simple as that. No stress. So I haven't done it yet, but I should be soon be 3 times bigger in CAS than I was. If there is a secret, ladies and gentlemen, to make your account grow, it's that you got to push your winners. Now, I went in 1986. I went to the US and I did my first technical analysis course in 1986, run by George Lane, and he was the father of the stochastic indicator, a larger-in-life character. I mentioned John Wayne a moment ago, but he looked like John Wayne in those late movies, Rooster Cogburn-type movies, exactly the same, a brute of a man. And he used to say that you push all trades without hesitation or reservation. And pushing is trader slang for adding to positions, folks. Victoria. Look at this broadening pattern, and earnings per share rising. Now, this is the biggest vendor of a manufacturer of carpets in the UK and in Australia. It's run by a very aggressive fellow and significantly undervalued. It had a 5-for-1 split not so long ago. Pushing at the top of this broadening pattern, there's 1, 2, 3. My mentor, Mr. Gann, would have said it's going to break on the 4th attempt, folks. So that looks good to me. I think that Victoria is going to go. So at the minute, just do what the front page of VectorVest tells you. VectorVest does not advocate buying stocks at this time. But if it turns to up again, then I think that is a play. Now, Wincanton, earnings per share has grown, maybe not as linearly as I would have liked. It's significantly undervalued, and we have a little bit of an ascending triangle here. For those of you that are technicians, again, 1, 2, 3 breaks in the 4th attempt, and I called that in the blog a week or 2 ago, and rising up the page. No fireworks, but going the right way. Okay, again, Bart Toledo would have been looking at a 52-week high here. Okay, and the 52-week high would have been there, and as it broke, pretty much the same place, as it broke the 52-week high, he would have been, and he loves the 52-week high. Shares that are undervalued, shares that are growing their earnings aggressively and safely, that break above a 52-week high, he's been living off it for a quarter of a century. Now, I have a search that will find all of these. Simon, how are we running for time there, sir?
David, yeah, we're just in the last couple of minutes.
Okay.
If we could maybe try and wrap up that.
Let me answer some questions if there's any questions.
Thank you. Yeah, well, the one actually goes back to Catherine, where we were on the stock viewer, and she noticed Rio was showing a value lower than the current price, and noticed that it was on a buy, and wanted to see if you could explain why that.
That's a really good question, because Rio Tinto is pretty much at our evaluation. It's got a reasonable, this is a good point, it's pretty much fully valued now, but over the next 3 years we believe that it's going to grow significantly. So if the price were to stay at $34.99, over the next 3 years it would be undervalued. So at our 1.2 is good. Relative safety is excellent, 1.41. It's on a buy recommendation, and largely, Catherine, it's on a buy recommendation because it's rising. Okay, this is really a trend-following number. So remember, the buy, sell, and hold are there to measure the breadth of the market, and they are not timing tools per se. And that is a very good thing that good point that you've brought up. As you can see, pretty much everything's on a buy recommendation here. We're not saying you go out and buy everything. This is just saying that these shares are rising. I would be happier if that was, for example, A and D. In other words, we had an advance and a decline and a hold there. That would be also a good number. And Simon, if it had been A and D, it would have meant that we wouldn't have had to do those ghastly exams, if you remember.
I never forget the exams.
They nearly bloody
enjoyed
killed me. So that's the answer to that. So this is rising. It measures the share is still rising. We can put the chart up and on Rio Tinto. There is our valuation, and we revalued this share as we revalued most mining stocks. As this, if you get a step input like this, it means that the numbers have come in and the numbers were significantly better than we anticipated. So pretty much fully valued now, but over the next 2 years, lots and lots to come. It's on a buy recommendation because, as you can see, it's trending at the page stall. So in terms of my rules, I would not be interested in this at the moment because it looks to me as if it's fully valued. So my rules are that the green must be above the price, earnings per share must be rising, and then I must see a breakout. And the front page of VectorVest must be telling me to buy. If I tick all those boxes, then I get very, very, very lucky indeed.
Okay, David, we'll need to wrap it up there, I'm afraid. We put the link in the box. Obviously, we encourage people to take up that offer for the 5-week trial, VectorVest.
Oh yes, that's why I put it in at the start, because I always run out of time. There's no risk here, folks. It's £5.95 for 5 weeks. That £5.95 is fully guaranteed if you don't think it's the best fiver you've ever spent. And my promise to you is that if I can't make you money, then you can stop it at any time. And as I assure you, we're fully authorized by the FCA. We're not going to put that at risk for 44 quid, I assure you. The product works, and quite simply, if it didn't work, I wouldn't put my name to it. As simple as that. The product works. It works very easily, and I've succeeded in making people that were serial losers for 20 years into winning traders by just ticking the boxes and following the rules. Simon, thank you very much for having me, and I look forward to seeing you anon. Okay, thanks very much, everyone.
Pleasure. Many thanks indeed for joining us. Bye-bye for now.
God bless. Bye-bye.